Everyone, this is Rob Roy of Elliott Wave Options, and welcome to the U.S. Market Update. It's Friday afternoon on August 4th, and the news of the week this week basically started on Tuesday, where we had the Fitch downgrade of the U.S. debt. And moving from AAA to AA plus, is that really a big deal? I don't think so, and I don't think it should have surprised anybody. We've been talking about this on Tuesday nights TradeFinders for quite some time. We've been showing you the chart of the U.S. debt clock and showing you how our current debt to GDP is running right at 120%. What that basically means is that the U.S. is living on credit cards at a 20% interest rate. That's kind of a pretty good analogy of where things are. So I just don't think the downgrade should have surprised many people at all. Taking a look at today's market, the news for today was the non-farm payrolls report came out. That's the government's version of the employment report. We have an ADP report that comes out on Wednesdays, and that has to do with the an independent viewpoint of where the jobs are. But the non-farm payrolls are the government's number. That came in a little weaker than expected. And with a lower opening, we kind of rallied a bit midday, and then around 1 o'clock in the afternoon, 1 o'clock Eastern time, we rolled over and ended up finishing near the lows of the day. And you can see the bar here. Now, if we bring the 10-day moving average onto the chart, you can see that we did get just above the 10-day moving average on the high. That's the lime green line, but we closed below yesterday's close. We're right at that 30-day moving average, which is the fuchsia line. I don't really use that for support resistance. I have the 10 and 30-day moving averages on my chart because old market makers, ex-market makers told me that floor traders look at that. So I like to look at when there's crosses. But that royal blue line is the key. That's the 50-day moving average. And I wonder if that's where we're going to wind up on the SPY before this little bit of a corrective move is over. Seems likely there's some support right there at 440. So again, I don't think that the downgrade was any sort of a big deal, but maybe that's where we end up. If you'd like to join us on TradeFinder, where we talk about all this kind of stuff, we do it every Tuesday night at 9 p.m. Eastern Time. It's free, so come along and join us. We talk about the markets. We talk about case studies, trade ideas, and we have a live Q&A at the end. It's a lot of fun. So you can go to our website at ewotrader.com and register there and join us each and every week. So all this stuff that I just went through are things that we talk about during TradeFinder. But looking for this move down, it just kind of makes sense that we move down towards 440 here with the 50-day moving average in place. Looking at the bond market, and we talk about that a lot in TradeFinder as well. I don't think you have to be an expert in bonds, but I think it makes sense to have a little bit of a working knowledge of the bond market. And we've talked for quite some time about this level. If you've been watching, you know, between 34 and 40, that's the area that I think is okay as far as tech stocks, the Magnificent Seven plus all the rest of the tech stocks in the Qs. But if we get above 4% on the 10-year, it starts to become harder for tech stocks. So blowing above that wave 3 high, you can see the Elliott wave pattern here labeled the wave 5. We touched the tap box. That stands for time and price projection. That's part of the Elliott wave algorithm. And if you're wondering about the software program, if you haven't seen it before, you can find out more information about it at hubb.com. They're the creators of this program. I think it's the best Elliott wave software that exists on the market, and it is programmed exactly to the Elliott wave algorithm that Elliott himself wrote. So it's nobody's personal adaptation of the algo. So we've touched that. Is that going to be the end of it? There have been some chatter on the financial networks today that some people think, some pundits think that we are going to back off, that was kind of a little bit of a run that we made. If we can get back below that 40 level, maybe we stay elevated with rates, get a little bit more of a pullback in the markets, and then we turn and move back to the upside. Perhaps that's what happens. But for now, as long as we stay above 40 here, above 4% on the 10-year, I think it is going to be challenging for the tech stock market. The dollar remains stubbornly above that 101 level that we've talked about for quite some time. We had that vertical break, as you know, and everyone's looking to get into the metals, but you just can't do it with a strong dollar. So we're right at the 61.8% fib corrective level in the wave 4 on the dollar. We're trying to back down. We're down around 102, but we got to get below 101. If we can get below 101 again without it being one of these vertical moves get retraced exactly as what you've seen occur here, then we can start talking about the metals again. We brought up the chart last week, but until we break below 101, just not going to be a meaningful bid in the metals, so we're just going to kind of let that go for now. So if we take a look at some of the rest of the markets, looking at the diamonds, the Dow, you can see that pretty much everything moved to the downside today. Put the Elliott wave pattern on. Once again, the Elliott wave algorithm just crushing it here on the DIA as we've been going just all the way back and forth through that time and price projection. There's a 5 buried in there that gives you the midpoint, but the upper line and the lower line are basically a error range, if you will, a range of motion of where you can go. And it's just hit the bottom and the top. So moving along through that area, you would suspect if the S&P is going to move back to 440, that we're probably going to see 345 on the DIA. I just speculation, perhaps that happens. We could break out and run higher. But there was some rotation into the Dow. There also was some rotation into the Russell as well on the chart of the IWM. We know about that, where we've been talking about 170 to 190 for so long. And we had this range here where we were at the low end at 170, the high end at 190. And then you know how we kind of compressed that trading range between 170 and 180 for a while. We broke above that. We've gotten above 190. The wave 5 is right at a 91% extension there. If we don't go higher than that, if we don't break that 100% extension, then we have to take into account that we might not just only come back and test 190 here. There's a possibility we come all the way back to this previous 4, so we could see the IWM come all the way down here to 180, which is right where that previous 4 is. So, if you're looking from a risk standpoint, you'd be encouraged that even with this little bit of a pullback, again, in my opinion, just kind of an excuse to take some profits so far. The fact that the IWM has held in there and didn't come crashing down worse than this, I think is constructive for the fact that this may be just a short-term pullback and the market might not be done moving to the upside yet. A lot of people look to the small caps as a good idea of risk, just like a lot of people look at Bitcoin, et cetera. And we'll take a look at Bitcoin here in a couple of minutes. Now, taking a look at the Qs, which is the one you think would have a rough time, and it kind of is. You can see how we're bouncing down here. You could argue that the Qs have already gotten down to their first level of support here around 370, and I think that makes sense with an elevated 10-year getting back above that 40 or 4% level. So we're already at the first level of potential support here on the Qs. If we can hold that and turn and move back to the upside, then perhaps we're getting ready for another run. But I think this 370 level is key. Now you look down, you can say, yeah, but the 50-day moving average is a little lower. You were talking about that with the S&P, and you'd be correct, which means that we have to allow the possibility that perhaps the Qs come somewhere, maybe all the way down to 360 or somewhere in this range where there is some congestion here between 370 and 360 on how far down we come here. So the Qs got there first. Are they going to be the leaders and bounce first, or does that mean they're going to lead us down just a little bit lower and those other levels that we've been talking about get hit? I think all that's going to be really interesting to see. And then taking a look at the VIX, if we take a look at the fact that we bounced back up to that 17 level and we closed, rallied into the close on the VIX because the market sold into the close. So that 17 level is back in play here. And maybe we're just testing it a few times and we're going to come back down lower. Or maybe that's just a precursor of things to come, because if the VIX breaks above 17 and takes off, maybe we have a little bit more of a correction than what we've been talking about in the cards here moving forward in the next couple of weeks. We'll find out pretty soon. But testing the 17 area on the VIX, I think, is certainly worth keeping an eye on. We break below this wave 5 level. And talked about how important that 61.8% extended level was on the wave 5 to the downside. So, we look at how it's consolidated here. That's why that's such a strong fib level. And that's why Elliott was such a big believer in looking at Elliott wave in conjunction with the Fibonacci levels. Now, taking a look at some stocks of interest. First of all, we got to look at Bitcoin, right? We just talked about how perhaps that's an indicator of risk as well. Pretty impressed that we've held this 29,000 level. We talked about that last week when we were here. If we break below 29,000, then we have to start looking down at maybe 27,000 here, perhaps even lower, down to 26,000. But so far, it's done a pretty good job of holding that 29,000. And if we do start to bounce here and start to rally back towards that the halving that occurs at the first quarter of next year, look at the moving averages all converging here, the 10, 30, and 50 all converging because we've been consolidating in this area for so long. That the longer we stay here, the greater the chance is, in my opinion, that we hold and we bounce higher. If we're going to break below that, I would think that would happen pretty soon, like maybe next week, or we could take off to the upside next week too. So the fact that we've been holding here for so long, I don't know how much longer we stay just dead sideways here on Bitcoin. I think it's going to give us a signal here fairly soon, and I would submit that likely next week that we bounce above 29,000 or bounce below and go down to 27,000. So it's going to be really interesting to see how that plays out. Now, the two big stocks of interest this week, I'm sure you've all heard about them, Amazon and Apple. And so let's take a look at the chart of Amazon first. Certainly was a really impressive move to the upside on Amazon today. And you close near the low of the day, as you can see on the chart, but nonetheless, just blow away earnings. Great earnings report. It shows the consumer still spending amongst all the other business interests that they have. But yeah, that was pretty darn impressive that are holding in this area and traveling out of town for the golf tournament. And, we talked about how we didn't really think people were maybe totally honest in that consumer confidence survey that said they weren't going to be traveling. There wasn't a parking place available at the Orlando airport, not one. And they've added a new terminal. They used to have A and B, now they have A, B, and C, and you had to go to off-campus ancillary parking, and that was pretty full. In all the years that I've been traveling, and I've traveled all over the world doing educational events, etc., never once have I not been able to find a parking place in the parking garage there. Sometimes it was up on the upper level on the roof, but never did I have to go to overflow parking. So the airports are busy, that I can tell you. Now, with oil moving back to the upside, how long will that take? I don't know. We talked about that in Tuesday night's TradeFinder. Perhaps we'll feature oil next week. But these two stocks, I think, certainly needed to be talked about. Now the issue we have is, where does Amazon go from here? You can see we touched the tap box already on the high of the day. Now we have this big gap up, and I hate that. So we've broken well above the 10-day moving average. So there's too much separation here. We're overbought short term, and we have a gap. So I think we kind of probably go sideways to maybe a little bit of give back over next week. Perhaps on Monday there's a little follow through, but the fact that we're already in this range of where the Elliott wave algorithm was forecasting the move, I think perhaps some consolidation and a little drift lower is likely from Amazon. But if you were long and you caught this, congratulations. And I just don't know what the catalyst would be for a big continuation in the short term. So we're going to need some backing and filling, I think, to summarize, and then perhaps we go higher from there. Now, the other story was Apple, other end of the coin. So gap down. So Amazon gaps up, Apple gaps down, and they were talking about decreasing demand, et cetera. People still loving the iPhones, et cetera, but other issues, they were seeing weaker demand. And not only did we gap to the downside, we closed near the low of the day below the 50-day moving average. So we did have a pretty good run in Apple, big 186% extension there on the wave 5. That could be it from Apple for a while. It was a really well-formed run here, just exactly the way you want it. That 45-degree angle with very minimal corrective move. That's why I like the 45-degree angle. But when you have a significant break like that, and you break below the 50-day moving average, if we get any sort of a bounce, if you're still long Apple and you're looking for an excuse to get out, maybe we bounce back to the upside here, close that gap around 190. I think if you could get 190, maybe some short-term profits you'd want to take with Apple, and then and let it rest for a while and reset. It's going to take some time for it to form a new impulse pattern. It's not going to do it right away. When you see something like that, that breaks the pattern. Now, I don't think that we're coming too significantly far to the downside. Apple has way too much money. They do way too many stock buybacks. Corrections are usually buying opportunities. Perhaps there's a little further to go on the corrective move. We could maybe come down towards this 170 level. I'm not even sure we go that far, but there is a lot of support right in that area. So I would say I don't think we go below that. But we're in no man's land here with this gap down below the 50-day moving average, and we'll see if we can jump back to the upside there, and maybe we drift a little bit lower here on Apple moving forward. And as I said, I don't know. I'm not trying to forecast that we're going to make it to 170. It's just that's where there's a lot of support. I don't think the correction would go below 170. Coming up next week, we got the inflation reports, the CPI, the PPI. Those are the things we'll be talking about in next week's market update. Certainly, that will move the market, you would think, because that's tying directly into the Fed, and now they've told us they're going to look at the data month to month and decide meeting to meeting. So I think those reports are going to be scrutinized even more than ever. So we'll be talking about them next week. Have a great weekend. Look forward to talking again soon. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.